Good afternoon, everyone. This is Brian Lenz, Director of Sales here at Epic Retirement Plan Services, and I'll be your host for today's call. For this edition of Epic Insight, we are joined by Jim LaPiedra, Relationship Manager, and Brian Dobbis, Director of Retirement Solutions for Lord Abbett, who will discuss the impact of increasing healthcare costs on retirement savings. Brian will also share how tax-advantaged health savings accounts, or HSAs, can have a significant impact on building a healthcare funding strategy and chat a little bit about how those interact with retirement accounts. As you're hopefully aware, this is a topic that is near and dear to our hearts at Epic. And with our My HSA solution, we bring to the table a 401k-inspired, saver-centric HSA that's completely integrated with our retirement plan record-keeping platform. So love the opportunity to chat with you about that if your interest is piqued by today's call. As a reminder, this session is also approved for CE for the CFA and CIMA designations, and you must stick around for the entire session to receive credit for that. Hopefully you submitted your credentials when you registered, but if you didn't, just shoot us an email and we will make sure to get those over to the Lord Abbett folks so they can submit for credit on your behalf. As always, your line will be muted, but Brian will be fielding questions throughout the call. So if you have anything that you want to address along the way, please do enter that into the questions panel and I'll run that by Brian. With that, we'll turn it over to Jim to say a few words.
Great. Thank you. And thank you for everyone on the call today for joining us. I really do appreciate your time this afternoon. Again, my name is Jim LaPiedra. I'm a relationship manager with Lord Abbett on our DCIO team. And I'm sure many of you on this call are familiar with Lord Abbett, but for those who are not, just a quick little refresher before we get into today's topics. Lord Abbett was founded back in 1929 as a private and independent partnership. And as a private and independent partnership, this allows us to have the sole focus on money management. And what do we mean by that? Well, 100% of our operating revenue comes from one business activity, and that's the management of your client's assets. Our vision is to be the most respected asset manager admired for our people, performance, relationships, and agility. We now manage over $230 billion in assets with award-winning funds in each asset class. This ranks us 15th in the industry as terms of AUM. And it's also been noted in publications that Lord Abbett is quickly and quietly becoming the fastest growing money manager over $100 billion. This is due to our explosive organic growth and net flows, which both rank in the top 5 amongst the top 25 active managers. Now, I mentioned we have a lot of great topics to discuss today, so we're excited to get into that. But a quick commercial for Lord Abbett, really highlighting our fixed income solutions. When you're thinking of putting funds into your retirement plan or using this on the retail side, please give Lord Abbett a consideration for 3 reasons. First, well, we've been managing money for over 90 years. We've also been managing taxable fixed income since the 1970s. Our bond debenture portfolio has over a 50-year track record. Second, we have a team of 75 investment professionals that manage over $175 billion in taxable fixed income assets. And third, and I think most importantly, especially for participants, is consistency of performance. Barron's ranked us last year #1 on our 10-year number for taxable fixed income. So at this time, I'd like to have Brian join the webinar. Brian is our retirement expert. I like to call him our walking encyclopedia of retirement knowledge. He has the alphabet soup of retirement designations after his name on his bio. But this webinar is for you. Brian's going to stop it a few times during this presentation. We like to keep it interactive, so please enter questions. But if not today, Lord Abbett is a partner with Epic, so we want to continue to be a resource. So always feel free to reach out to myself or your Lord Abbett wholesaler. We'd be happy to get you in touch with Brian. If there's a case you're working on with a client or something you'd just like to, throw out a question or use as a blackboard, Brian's here for your assistance. So Brian, why don't you take it away?
Thank you, Jim. Thank you very much for those kind words, Brian. Thank you for having me on today's call. Good afternoon, everyone. I hope you're doing well wherever in the country you are. Again, to Jim and Brian's points, let me reiterate, any questions you may have, please use the chat function liberally. We want to make sure we get your questions, your inquiries answered. We have a lot to go through today. We're going to give you some business building ideas through HSAs. We'll clear up any misconceptions prospects may have pertaining to HSAs and give you the ammunition you need to build your business via the HSA program or product offered by Epic. So let's kick back and get started. Why do HSAs matter? We're going to build that foundation. I think a lot of this we might, you're probably familiar with, but I want to kind of go into the details a little bit. Healthcare costs continue to rise. I mean, I don't think that's any surprise. That could be deductibles, premiums, co-insurance, prescription drugs. And it's imperative that when you are working with a prospect or a client and you're talking holistically about retirement or retirement income or creating that blueprint for retirement income, that the question is asked to a prospect or a client, how do you anticipate, how do you plan on covering your medical bills in retirement? And a lot of folks are going to say Medicare, and that's great. Medicare is a phenomenal program. But one of the things I want to just make sure that your clients understand is Medicare is not free. It's not anything close to free. There's a lot of costs, which you're going to see today. Health savings accounts can help offset a lot of those future costs, whether they're through Medicare or even for those services that aren't offered by Medicare. Second, just so we can kind of get a feel for what retirement is or what healthcare costs are going to cost in retirement. The estimate for retiree healthcare spending rises to an average of $315,000 per couple, excluding long-term care expenses. This is an annual number that Fidelity provides in their healthcare survey. That $315,000 is $165,000 for the wife and $150,000 for the husband. The wife has a little bit more because women tend to live longer. And the key takeaway here is, besides the number itself, is it does not include long-term care, nor does Medicare. So right there, ladies and gentlemen, is an opportunity to just discuss with clients, hey, if you need long-term care, unfortunately, if you do need that, what a lot of people do, how are we going to cover the cost of long-term care along with your basic medical needs? And again, a health savings account, as you're going to see, can help with that. HSAs have an investment for long-term healthcare costs. Folks, the good news is more and more taxpayers are establishing and funding HSAs. The not so good news is people, investors, healthcare HSA owners are not aware that they can invest their HSA money. A lot of people think you just put it in cash and that's it. They don't realize there's mutual funds and other options. And as I've alluded to in my opening comments, healthcare costs will impact your retirement income savings. So it's critical as a financial professional holistically to discuss retirement income needs and how those income needs are going to interact with healthcare costs for your client and their family. I mentioned this a moment ago in the prior example, but here's that statistic, and just so you can kind of get a feel for how much the numbers are going up. Again, the source here is Fidelity. We're talking over the last decade plus a 26% increase in average healthcare costs. And back in 2002, roughly 20 years ago, when Fidelity first came out with this healthcare survey, the number was significantly lower. I believe it was about 160,000. So as we all know, folks, healthcare costs are rising faster than inflation, and we need to be aware of how this is going to impact our retirement income. Before we get into some of the nuts and bolts of health savings accounts, just holistically, a quick view of where the assets are in HSAs, just so we can kind of get a feel for the market. As of the end of 2021, December 31st, 2021, there was $98 billion in health savings accounts. And as you can see on your screen, about 63 or 64 billion were in deposits, where about 34 billion were invested in the market in mutual funds, etc. So there's a lot of folks out there who have HSAs, make deposits, but don't invest it. It's simply sitting in cash, which isn't necessarily a bad thing. But if you're looking to have these HSAs to be used for future costs, the financial professional can help these clients and prospects set up a portfolio to meet those costs. Whereas the money just sits all in cash, you're not going to keep up, needless to say, with inflation. Folks, here you can just see the assets, as I mentioned from the prior screen, what's invested. Here you can see in this slide, the pie chart, how the money is contributed. Where is the funding from HSAs coming? And just a key takeaway here, folks, I think you might find this pretty interesting. 61% of contributions to HSAs as of last year were made by the employer. And this is a big takeaway. Most employers provide annual contributions to your HSA. That's free money. It's like a match without a vesting schedule. If you participate in the high deductible health plan by the employer and they offer an HSA, they're going to give you contributions. As Jim and I know, our own employer, Lord Abbett, does that on behalf of our employees. The employer will give you seed money annually. Now, how much the employer provides, that will be determined employer by employer. Now, you may be thinking, hey, Brian, so far this is good stuff. HSAs are, they offer the ability to help cover costs in the future. Why don't more people utilize these? Why aren't we getting more, as the advisor, why aren't more people calling us and asking us questions? Well, there's a lot of issues with education, and I think that's the crux of today's call. How you as the financial professional, with the assistance of Lord Abbett, as a partnership, we can help unwind that knot of miscommunication and miscommunication. And I hear this all the time, even from my own colleagues or when I'm out in the field, working with advisors and their clients on HSAs. You can see the misconception. And let's go all the way to the right. The big one is HSA holders must participate in a high deductible health plan. So folks, the key takeaway here is if a client or a prospect employer doesn't have a high deductible health plan, they can't participate. It's unfortunate, but that's the way the rules work. Second big takeaway is clients confuse health savings accounts with flexible savings accounts. So, flexible spending accounts with health savings accounts. They're different, folks. They have certain things in common, but the big takeaway, which I'll get into in more detail in a future slide, is an FSA you have to use in the same year, use it or lose it. A health savings account, you can use it any time in the future. I go to the doctor today, spend $50. As long as I have an HSA set up, I can pay for the doctor's visit using some other form of income, a checking account, a credit card, whatever, and I can reimburse myself 20, 30, 40, 50 years from now. There's no deadline. And let's move over to the left here. 37%, as I mentioned a little while ago. There is more than a third of HSA owners who don't realize that you can invest HSA dollars to help supplement long-term savings, i.e. in mutual funds. And there's even a third, 30% or a little less than a third, that don't realize all the tax benefits that HSAs offer. They're triple taxed advantage, and we'll get into that in a moment. HSA benefits, too good to be true. Well, let's start with all the benefits that HSAs offer, and there are a lot. HSAs are triple tax advantaged. So right off the bat, by making a contribution to an HSA, you receive a federal tax deduction, a state tax deduction, your dollars grow tax deferred, and your distributions, including earnings, are withdrawn tax-free, as long as you use them for qualified medical expenses. So a health savings account has all the features of a Roth IRA plus a tax deduction. That's amazing. Even the almighty Roth, which I'm a huge fan of, doesn't offer a tax deduction. I fund my HSA today. I get a federal tax deduction, and most states, I believe 48 of the 50 states, offer a state tax deduction. And furthermore, you can use the HSA for yourself as the account owner, for your spouse, and your dependents. As I said a little while ago, the employer may contribute. You can contribute. There's a lot of flexibility here. You can contribute up until April 15th for the prior year, just like an IRA. So you can make a HSA contribution until April 15th, 2023 for the 2022 year. there's no income requirement. So unlike, say, an IRA, you don't even need earned income. Earned and unearned income is allowed. Anyone can fund an IRA for an HSA for anyone else. So if Jim wants to write a check out and fund my HSA, he absolutely can. If I have kids who have an HSA and they don't have the money to fund it, I can fund their HSA. And finally, if you make HSA contributions directly from your paycheck, from payroll, you avoid payroll taxes. So if Lord Abbett is taking out HSA contributions from my paycheck right off the bat, I save 7.65% for FICA and Medicare. Folks, even the almighty 401k is assessed payroll taxes. So it is ideal if you have a client who wants to fund their HSA to do it out of their paycheck to avoid the payroll taxes. If they write a check out and don't do it through payroll, you still get the tax deduction, but you do not get the benefit of avoiding payroll taxes. Furthermore, the benefits continue. Distributions are permitted at any time. There's no age 59.5 rule or anything like that. Again, use it or lose it does not apply. You can use HSAs, again, for yourself, your spouse, your dependent kids, anytime in the future, as long as the expenses were incurred after the HSA was established. So I can't say, you know what, I had this big operation 20 years ago, and it cost me 30 grand. I'm going to reimburse myself for that. That doesn't work. It's anything perspective once the HSA is established. What happens if you take a distribution from a health savings account that is not for a qualified medical expense? Well, unfortunately, life happens and your clients may need to access an HSA for a car that breaks down or some other emergency. In that situation, the account owner is subject to income taxes, federal, state, local, if applicable, and a 20% penalty, not 10% that applies to 401ks and IRAs, but 20%. There are no required minimum distributions. So at age 72, you don't have to start taking assets. You don't have to start taking income like with a 401k and IRA. And finally, this is important for both the client and the financial advisor. Your client owns the HSA. So let's use me again. I have an HSA with Lord Abbett. Say I don't like the investments, or I just don't like the service, or just not happy with the HSA. Can I transfer it to Epic's HSA? Absolutely. I can transfer it whenever I want. It's a trustee transfer, and I can move it while I'm employed, after I'm employed. Doesn't make a difference. But one nuance, what Lord Abbett in my example probably will not do is they won't send new money to the Epic HSA. They'll still continue to send deferrals to their HSA. Then it would be upon me to do transfer. So it's a little cumbersome, but it absolutely can be done. Before I move on to the overview and the eligibility as to who can set up these accounts, what are some of the nuances? Brian, are there any questions that have come through from today's attendees?
Yeah, we've got one here for you. So if on Medicare, Brian, can you still qualify for an HSA, or is that not considered a high deductible health plan?
Yeah, Brian, I'm going to get to that. We have an entire section on Medicare and the interaction. So I'm going to hold off from responding to that, for I can give the attendees all the information regarding the interaction of age 65 and Medicare in a few minutes.
Fair enough. Thank you.
Okay.
That's it.
All right, folks, great question. Keep the questions coming, please. So eligibility. The amount that you can contribute to an HSA depends on your age and the type of coverage you have. Making contributions to an HSA when you are not eligible can lead to penalties. So if you're not eligible and you fund an HSA, the IRS is going to catch you. Then you're going to need to unwind it, and it's going to be messy, time-consuming, and expensive. And again, unlike IRAs and 401ks, there's no income test. You simply need to participate in a high deductible health plan. Folks, high deductible health plan, an HSA, is designed to be used in conjunction with a high deductible health plan. And again, you must be covered in it. Folks, so this is when you're discussing HSAs, the very first question to ask is, does Mr. Client, Mrs. Prospect, does your employer offer a high deductible health plan? And if so, are you enrolled in it? And the timing for this is perfect because most employers have open enrollment in the next couple months, October, November. So if you have a client who maybe has a high deductible health plan but is not enrolled in it, maybe they use the traditional plan like the point of service plan, this might be an opportunity to have them switch health insurance if it works for them, and then fund a high deductible health plan. One of the key takeaways on a high deductible health plan is, and there's a lot of them, folks, is you cannot get any benefit beyond preventive care before meeting the annual deductible. And I think this is critical, ladies and gentlemen, when you start going down the eligibility rabbit hole. Mr. Client, if you switch to a high deductible health plan, that's fine. But one takeaway, the plan is going to cover nothing until you reach your deductible. And as you see, I put the slide up there with the numbers, what the minimum deductibles are for 2022, and the IRS has already released the numbers for 2023. And as you can see, they went up a little due to inflation. So if I have coverage through Lord Abbett and I'm not married, just me, self-only, individual coverage, I know I have to pay $1,400 minimum out of pocket before the plan will pay anything at all, including prescription drugs. So that's a big takeaway. If you have family coverage, which is defined as single coverage plus one, so it could be me plus my spouse, me plus a child, it doubles. Everything's doubled, $2,800. Furthermore, not all high deductible health plans are HSA eligible. So just because a client says, yes, Mrs. Advisor, I have a high deductible health plan at work, you cannot say, okay, you're automatically HSA eligible. Instead, the high deductible health plan must meet certain criteria, which the IRS sets annually, the minimum deductibles and maximum out-of-pocket expenses. So if the if the high deductible health plan doesn't meet the IRS requirements, it still might be a high deductible health plan, but not one that is eligible for an HSA. If your client is unsure and you don't feel comfortable digging into the plan, which I totally understand, the client could check with their HR department or simply call Blue Cross, Blue Shield, United Healthcare, Aetna, and just ask them if they are eligible, if it's an HSA eligible plan. And the key takeaway here is twofold. One, as I mentioned, let me reiterate, not all high deductible health plans are HSA eligible. And number two, this could change year to year. It could be eligible in 2022, and then the plan may not be eligible in 2023. So you do need to check every year to make sure that the employer's health plan does remain HSA eligible. Number two, after having a high deductible health plan, that's just one step. We now have a couple more hoops to jump through. Number two, you cannot have any other health care coverage and be considered an eligible individual. For example, you cannot be enrolled in both a high deductible health plan and your spouse's plan. So let's say I'm married and I have my high deductible health plan through Lord Abbett, and my wife also has a health plan, which she covers me, but it's not a high deductible health plan. I'm ineligible now because I now have other health coverage that is not from a high deductible health plan. Furthermore, you are unable to participate in HSA and FSA unless the FSA is a limited purpose FSA, which is defined as being used for vision care and dental expenses. So folks, the takeaway here is if a client is married, ask about the other spouse's health insurance and whether they are covered by the other spouse's health insurance. And number three, you cannot be a dependent on someone else's tax return and contribute to your own HSA. So minor children, for example, if you have a minor, they can't set up their own HSA because they're most likely a dependent. However, this is a huge takeaway, folks. If you're jotting down notes and you want to add the ultimate value to a client, I'm going to spend a moment or two in this because I think this is huge. From my travels, most accountants aren't aware of what I'm about to discuss. Let me take a step back. Discuss when you're having the conversation regarding health insurance, retirements, HSAs, one of the most imperative questions or innocuous questions that you can ask a client is, Mr. Client, do you cover your independent adult children on your health plan? Let me repeat that. Mr. Client, do you cover your independent adult children on your health plan? Let's say the client says, yes, I'm your client. We'll use me as an example. I work for Lord Abbett, and let's say I have twin daughters, both age 24. They work full time. They have a full, they have a full-time job, but I'm very generous. I am covering them under my Lord Abbett plan. I have a high deductible health plan, and I have family coverage. It's me, my spouse, and my two twin daughters. I can cover them because my plan allows adults to be covered until age 26. In the HSA world, there is a huge benefit here, folks. How much can I contribute to an HSA for my family this year? Well, let's break it down. In 2022, family coverage allows $7,300. So the $7,300 in my example would be between my wife and I. So between my wife and I, we together can contribute $7,300. How that $7,300 is contributed is up to us. We can put half the $7,300, $3,650 in an IRA for her. An HSA for her, the other $3,650 in an HSA for me, all $7,300 in mine, whatever breakdown we want, but it cannot it cannot exceed $7,300. But here's the big takeaway, folks. When it comes to my twin daughters, since they are not a dependent, they're independent, but they are covered under my health insurance, they each get their own health savings account limit of $7,300. So I can, if I'm generous enough and I have the income, I can make a $7,300 contribution to each of my twin daughters into their own health savings account. And they not only would have $7,300 growing tax deferred and distributed tax free for medical expenses, they would also get a tax deduction because there's their own HSA. Folks, most people don't realize that you can take that $7,300 and you can expand it or extend it to the adult independent children. And the key takeaway here, folks, is the kids have to be independent. So again, huge opportunity there. Most clients, in my experience, are not aware that they can do that for their adult kids who are enrolled in mom and dad's health insurance. And then to
Brian, let me stop you there because we had a question come in related to that. I think it would be timely just to confirm. In that instance where it is a non-dependent child under your coverage, the child gets the tax deduction even if you are making the contribution. Is that
correct?
That accurate?
Yep, that is correct. So Brian, if you have it, using my example, I make the contribution of the $7,300 for my 23-year-old independent adult daughter. It's her HSA. I'm just simply funding it on her behalf. She gets the tax benefit.
And if it is a dependent, then you cannot contribute, or it's just a combined $7,300.
But that is correct for contribution, but I can then reimburse myself for my dependent's medical expenses. So if my 23-year-old is a dependent, then if she has a lot of medical expenses, I can use my HSA to reimburse myself for her medical expenses.
Got it.
So,
all right, we have a few more unrelated to that. If you want to roll with some questions now before we get into the next topic here.
Let me just finish up this slide, Brian, and then we'll before we transition to the next topic, I'll take those questions. Is that okay?
Sure.
Okay. So, folks, the fourth piece of the eligibility, and as the person, the attendee asked earlier, you cannot be enrolled in Medicare and fund your HSA. Medicare is not a high deductible health care plan. So upon enrolling in Medicare, you are not eligible to contribute to an HSA for that month. Applying for Medicare after age 65, remember that Medicare coverage is retroactive up to 6 months prior. So what happens when you enroll in Medicare, it disqualifies you from being an eligible individual for those months. You can no longer make contributions to it, but you can still use your HSA for qualified expenses. So let's say, assuming you meet all these requirements and you're now eligible, how does the financial advisor, where do you go from there? Well, I think the big takeaway here is Eligibility in the world of HSAs is determined monthly. It's not like an IRA where you can send in the $6,000 on January 2nd before you even earned $6,000 for the year. Here, instead, it's monthly. Every month you're eligible for the HSA, you can fund 1/12 of the contribution. If you know you're going to be eligible for the whole year, you can always pre-fund it. But what happens if you change jobs mid-year? What happens if your spouse changed jobs and you're on her HSA? Folks, just remember, if you don't qualify for 1 month, you cannot fund the HSA for that 1 month. Instead, the contribution limit for the year is prorated, with one exception. And I'm not going to go through all the nuances. It's there for your benefit. If you first become eligible for an HSA the last month of the year, December, you are eligible to fund the HSA for the whole year. So what the rules state is, well, we're not just going to let you just contribute 1/12. That kind of defeats the whole purpose. We'll let you contribute the amount you're eligible for the whole year, but you then must be eligible for 1 year going forward, called a last month rule. So if I first become eligible for the Lord Abbett plan on December 1st, I can contribute the whole $7,300 if I have family coverage. But the flip side is I must now stay eligible for 1 more year. And if I don't, then there becomes taxes and penalties that apply. So again, folks, takeaway here, monthly, not annually. And here's your limits for the year, just so you can kind of get a picture of what the contribution limits are, not only for this year, what they are for next year, what the minimum deductibles are, and what the maximum out-of-pocket costs are. So you can help your client determine whether an HSA meets their needs and what their potential maximum out-of-pocket would be for them and their family. So Brian, before I move on to rollovers, let's see what questions have come through, please.
All right. Very nice picture there, Brian. Related to your most recent topic, can you use your HSA to pay Medicare premiums? We heard that you cannot contribute to an HSA while on Medicare, but I assume that paying using an existing HSA that was funded is no problem.
That is correct. Yes, you can use your health savings account to pay for Medicare premiums tax-free. Absolutely correct.
All right, and then wrapping up the child conversation, do the independent children in the scenario you described need any earned income? Is there any earned income factored into HSA contributions at all, or is it simply if they have the high deductible health plan, they can fire away? Although I guess you'd be foregoing one aspect of the tax advantage there.
You do not need earned income. You absolutely do not. You just simply need to meet those 4 requirements that we just went through at length. So if you have a child that's independent and has no earned income, he or she would be eligible to fund the HSA, or excuse me, anyone can fund the HSA, or they can do it themselves using some other income, a checking account, savings account, whatever.
All right. Going back to some earlier questions, for small employers where the owners are employees, are there any discrimination testing traps to be concerned with?
Yeah, that's a really good question. Not that I am aware of. So unlike in a 401k, there's no aggregation rules or attribution rules or controlled groups or anything of that nature. As far as I'm aware, there aren't. But I do know that healthcare plans, some of them are subject to ERISA. I would double check with a healthcare broker just to make sure I'm not overlooking something. I feel pretty comfortable with my response, but not 100% sure.
All right. Thank you, Brian. And another employer-related question, what documentation, if any, does an employer need to get set up to run those HSA contributions through payroll and avoid FICA?
I mean, it's just like working with your payroll provider. So it's just like your 401k or any other deductions, your health insurance, disability insurance. You fill out paperwork, or you go online, the employee fills out their HSA, how much they want withheld from their pay, and then the payroll provider should be aware not to withhold FICA taxes. from the 7.65% from those contribution amounts.
All right, great. All right, related to some of the limits, maybe if you want to go back to that page you just showed so people see it while we talk about it. For the, I think it might be the wrong age here, but they entered 50, but I assume the question means if you turn 55 at the end of a year, do you get the full $1,000
Yes.
catch-up?
Yeah, so the catch-up works like the age 50 contribution for retirement plans. In the year you reach age 55, you would be eligible for the $1,000 catch-up.
All right. And then lastly, related to interplay between HSAs and FSAs, does the HSA affect a dependent care FSA, i.e. for child care? Is there any consideration between the two?
For some reason, Brian, I'm drawing a blank on that. I think there is. Whomever asked that question, if you'd like to reach out to me offline, I would be happy to provide you an answer. Or Brian, if you want to provide me that attendee's information, I can reach out to him or her. I think there is. I'm just drawing a blank on that. That's a great question, and I'll be happy to get back to them on that answer.
Okay, thanks. All right, we're ready to go.
Okay, great. Thank you, Brian. So rollovers, folks, there is rollover opportunities here. You can roll over from a medical savings account into an HSA, and a medical savings account was kind of the precursor for HSAs. And you're not required to be eligible to do a rollover, and you're not required for a rollover to be made in cash. And rollovers, just like IRA rollovers, are not subject to the annual HSA contribution limit. However, something to keep in mind, if a client is going to do an HSA rollover from one HSA to another, and they do not do a direct trustee transfer, you only get one rollover a year, just like IRAs. So if they're going to take the HSA money out of the Lord Abbett HSA and move it over to Epic, and they could do it through 60 days, you get one per every 365 days. Whereas if you do trustee transfers, again, just like IRAs, it's an unlimited amount. Qualified HSA funding distribution. All right, folks, there's a lot of information on this slide. Once per life, not once per year, once per life, an individual can do a tax-free direct transfer of funds from an IRA to an HSA, thus moving taxable money into an HSA and distribute it tax-free. So let me go through an example because that's really wordy and a bunch of jargon. I have an IRA, a traditional IRA, and I'm now eligible to fund an HSA through my Lord Abbett plan. I can, if I want, take traditional IRA money and do a direct transfer into my HSA. So I'm taking otherwise pre-tax taxable money, transferring it into the HSA, no taxes, and then as long as I use it for qualified medical expenses, no taxes there either. That's called a qualified funding distribution. The distribution is not included in income, and the transfer, the qualified funding distribution, can be made from a traditional IRA, a Roth IRA, or even an inherited IRA. However, an ongoing or active SEP or simple is not permitted. The transfer of funds must be done via a trustee transfer. So the money must be moved directly from my IRA directly to my HSA. 60-day rollovers are not permitted. Furthermore, only pre-tax IRA funds can be transferred. So if you have any basis in an IRA after tax dollars, those dollars cannot be transferred. This is a good thing. You only want pre-tax money. However, I know a lot of you are probably like, Brian, this is amazing. This is great. What's the catch? There is a catch. The maximum amount a client can utilize this technique is the maximum allowable HSA contribution for that year. So let's go back here for a second, folks. The maximum amount in 2022 an individual can utilize for a HSA funding transfer is $8,300. How did I get that? If you have a client that has family coverage and they're age 55 and above, $7,300 plus the $1,000 catch-up, $8,300. Furthermore, if you transfer the $8,300 from your IRA to the HSA, you cannot make the annual contribution. That transfer fills up your HSA contribution for the year. Furthermore, if you do a transfer, you do not get a tax deduction for it. You're simply getting the benefit of taking otherwise taxable money and transferring it into a potentially tax-free account. Now, with all that being said, you're probably thinking, all right, Brian, well, you just kind of ruined it for me, that this isn't that great. Who would this work for? There's two situations that I've seen that this applies to. One is if you have a client who is eligible to fund an HSA and doesn't have the money. They just can't afford it, and they have an IRA. Well, take the IRA money, which is eventually going to get taxed, moved it into the HSA, and then you can use it tax-free. Second situation, if you have a client who has a medical emergency and doesn't have an HSA but has an IRA, if they take a distribution from the IRA and they're under 59.5, they're probably going to get assessed a 10% penalty plus taxes. If they're eligible for the HSA, transfer the IRA money into an HSA and then distribute it from the HSA to pay for the medical emergency. You just avoided taxes and the 10% penalty. Those are the two situations I've seen frequently where an advisor can add a ton of value and save clients significant dollars in taxes and or penalties. And folks, also regarding the once per lifetime transfer, there is a testing period here as well. If you do that one-time transfer, you must be covered for the high deductible health plan for 12 months after the distribution. So if you do a transfer in the next year, like, I don't want to use this HSA, I want to go back to another plan or switch jobs or whatever the scenario may be, guess what, folks? That qualified tax-free transfer is no longer tax-free. It's now reported in income taxable. Finally, how do you report one of these? If you have a client that does one of these, the likelihood that the accountant is familiar with these, probably not going to happen. And unfortunately, the IRS does not have a code on the 1099 that reports these. So it's imperative for you to work with the client and the accountant to let him or her know what transpired and to ensure that your client does receive the tax-free treatment that they're eligible for. Okay. HSAs at age 65. 65 is the big year or the big age with HSAs. With retirement accounts, we know it's 59.5. HSAs at 65. So as I said earlier, and let me reiterate, you lose eligibility to fund an HSA the first day of the month you turn 65 and enroll in Medicare. Enrollment in any Medicare coverage, A, B, C, or D, will end eligibility. However, you do receive a prorated contribution for the amounts before becoming ineligible. So if you become ineligible July 1st, you still get 6 months of contributions for that year. Why? Because again, HSA eligibility is determined monthly. But you also gain a benefit at age 65. And this is a huge benefit, and this is a lot of value for the advisor. The 20% penalty that applies for taking a distribution from an HSA for non-medical costs evaporates, goes bye-bye at age 65. So let's stop right there. At age 65 and older, an HSA is taxed for non-medical expenses identical as a traditional IRA or a pre-tax 401k. You take the money out, you're subject to income tax. And that is critical, as you're going to see in a slide when I talk about beneficiary planning, so keep that in mind. And then new benefits. Folks, insurance premiums generally are not considered qualified medical expenses, except in certain situations. I said it earlier, let me reiterate. You can pay for Medicare premiums, tax-free, COBRA, and long-term care. Remember the beginning of the seminar, I went through long-term care. Medicare doesn't cover it. Long-term care is crazy expensive. Most folks can't afford it. Well, HSAs offer the ability to pay for long-term care premiums tax-free via a health savings account. From a tax and reporting standpoint, the bulk of compliance with HSAs rests with your client, the employee. The employer responsibility is really minimal. The employee is responsible for determining eligibility, although the employer can help with education. The employee is going to determine how much they can contribute, which will be based on coverage and or age and how many months they're eligible for the plan. Distributions. So folks, I've gone through a number of times today. medical expenses are distributed tax-free. Well, that's great. How do you prove that? How do you prove that it's really for a medical expense? You must substantiate distributions by saving the receipts. It is critical every time a client has a medical cost that they save those receipts. Now, what do people do? They take those receipts and they just send them into the cloud. They scan them in and they save them in the cloud, for they have all their medical expenses for them being the account owner, for their spouse, and their dependent children. So you could theoretically save up all your receipts. Say you got $30,000, $40,000 of receipts. You can take in any time in your life a $30,000 distribution tax-free. Account management. The employee is responsible for the investments, the contact information, beneficiary naming, very much like a retirement account. And then lastly, just keep in mind, ladies and gentlemen, that tax reporting, there is a form, the 8888 form, that tracks any activity in an HSA, contributions, distributions, etc. Oh, I'm sorry, not the 8888, my apology, I misspoke, the 8889. Form 8889, health savings accounts. This is attached to the 1040 any year you have activity in an HSA to ensure that you do not take a larger deduction and you pay taxes and penalties for ineligible distributions. You even file the 8889 if your employer makes contributions and you do not. So let's say Lord Abbett gives me $2,000 every year and I just don't want to fund my own. I still need to fund the 8889 to show that Lord Abbett made those contributions on my behalf. Just like with retirement accounts, there's a 1099, but it's an SA as opposed to an R, savings account versus retirement. There's a 5498, just like with IRAs, and just miscellaneous. If your client calls you up and asks this really like one-off question, is certain type of procedure covered? And you don't know the answer and you don't even feel comfortable answering it. There's different publications that go through what is covered, and that's publication 502 and publication 969 that really get into the weeds or the nuances of health savings accounts and what is the eligibility and what services are covered and considered a qualified medical expense. All right, and let's finish up with this, ladies and gentlemen, naming a beneficiary. Just like with 401ks and IRAs, an HSA owner should name a beneficiary. At death, the remaining funds are payable to the named beneficiary. So folks, HSAs, just like IRAs and 401ks and 403bs, are non-probate accounts. Who you name as your beneficiary will inherit your HSA. But that's pretty much where the likeness of retirement accounts and HSAs start and end. Here's why. If you name your spouse as a health savings account beneficiary, when the account owner dies, when the spouse dies and the surviving spouse inherits, it becomes theirs. I have an HSA, I die, I name my wife. She now owns it, and she can take qualified medical expenses, and she doesn't need to be covered by an HSA eligible insurance to maintain the HSA. Granted, she can't fund it, but she can still use it for medical expenses for herself and if we have any dependents. So I die, she gets it re-registered under her name. Where things change significantly is when a non-spouse inherits an HSA. Folks, there's no such thing as an inherited HSA. There's no such thing as a stretch HSA. Instead, the rules are really rigid. If I leave the IRA, the HSA to anyone besides my wife, the entire amount of the HSA is taxable to my non-spouse beneficiary. I die, I leave it to my nephew. I have $100,000 on my HSA. My nephew now has $100,000 of taxable income. Case closed. There's no way to defer the taxes. Now, let me take a step back here. Do you remember I said a slide or two ago that there's that benefit once you turn age 65, that the 20% penalty goes away? Let me ask everyone a rhetorical question. Let's say you have a client who has an IRA and has an HSA, and let's say they're single, so there's no spouse involved. Would it make more sense once they turn 65 and as they get older to start drawing down on the HSA or start drawing down on the IRA? If they're looking to leave significant assets to a beneficiary, then I would say draw down on the HSA, right? Because you're going to want to leave the beneficiary the IRA. The IRA is going to give you the 10-year payout rule, or maybe maybe even the stretch, depending on what type of beneficiary it is. But I think that's critical for income planning and legacy planning to be familiar with the nuance of an HSA inheritance for a non-spouse versus an IRA. That said, there's one special rule that applies. If you name the estate directly on the beneficiary form, the total distribution of the HSA assets will be included on the deceased owner's final tax return, not the non-spouse beneficiary. So say my nephew says to me, Brian, I appreciate you leaving this HSA, but this $100,000 of income is going to blow me up. It's going to bump me into a higher tax bracket. It's going to phase me out of all these means tested benefits. I don't want it. Or maybe, you know what? Give me only half of it. Give me 50, or give me half. Folks, instead I can say name the estate and it would all be taxed on my last tax return. I'm no longer with us. I really don't care. And then I can give maybe my nephew, using this example, assets outside of the HSA. And then drawbacks, folks. I know we're just about out of time, but real briefly here, just to be fair and balanced, there are things to consider that aren't, don't show all the benefits. If you participate or enrolled in a high deductible plan, do you have the funds to cover the deductible? If a client, God forbid, gets, goes to the hospital with some major healthcare scare, they're going to need to come up with the funds, the money to cover the minimum deductible, $1,400, $2,800 at minimum to cover those dollars. And of course, any other out-of-pocket expenses. Taxes and penalties. Again, if you use the HSA for non-qualified medical expenses, it's pretty hefty. Taxes and a 20% penalty. You need to create a process to keep track of all the records and/or expensive. You don't have the receipts, and the IRS audits you. You find yourself in a little bit of a pickle. Convenience. I've spoke today at length about the benefits of long-term growth in a health savings account. But folks, a lot of people just use them immediately. Most health savings accounts come with a debit card, and people are like, oh, this is great. It's tax-free. I'm just going to swipe my card. There's nothing per se wrong with that, but it kind of defeats the purpose of using them for long-term expenses, working with a financial advisor, creating a portfolio, having that portfolio grow over the years to use for medical expenses. Why? Because what's the rule of thumb? As you get older, your medical expenses are going to increase. And it's nice to know you do have that pool of money that can be used tax-free for those medical expenses. And as we discussed, Medicare premiums, long-term premiums, etc. Investments, mutual funds. Most providers do have a minimum balance requirement, which absolutely is not a bad thing because you do want a portion kept in cash for an emergency. And just be aware of fees. You folks have a great plan. You can compare it to where your clients maybe currently have a plan and compare the fees. A lot of these providers charge fees for account fees, minimum balance fees, a debit card fee, et cetera, et cetera. So you get to know, some of the more common providers in your territory, in your area, and see how your program, your plan is superior. And here's just your action plan, folks. Include HSA planning in all client reviews, integrate HSA planning into your overall retirement income plan, provide participants education and advice, and be a market differentiator. Learn this product inside and out and how it can assist clients, their adult independent children, as we talked about, and their dependent kids saving for future medical expenses. And then, folks, to end today, we have a very well-received, very popular column that I write weekly or bi-weekly that covers all tax-qualified accounts. We have a lot of stuff out there on HSAs. As you can see here, we have something on the new Secure Act 2.0, which could be a huge, huge, huge bill that will impact retirement accounts. So again, let me just say thank you on behalf of Jimmy and me for having Lord Abbett today. Brian, thank you again for having us. I'm going to send it back to you for some closing comments or to see if we have any more questions.
Yeah, I think you nailed the questions along the way, Brian. I appreciate all the info. One thing that might be worth reiterating, because I've seen this come up as a surprise before, is can you reiterate the details surrounding using the HSA to basically cut yourself a check for medical expenses that you have accrued along the way, as long as you've saved the receipts? As in, I don't necessarily need to use that money to pay for medical expenses that come up prospectively. I can give myself that tax-free money transfer for any expense that I've incurred along the way.
You just nailed
Probably
it,
didn't
Brian.
say that eloquently, but I think that's worth reiterating one more time because it's often overlooked.
Yeah, you know, Brian, let me use a phone call that I got from an advisor a few days ago. He asked me, he has a client who had $50,000 saved in a health savings account, and the client wanted nothing more than to buy a boat for himself, a yacht for himself. And the question was, he has $50,000 in medical receipts over the years. Can he take the $50,000 in receipts and just take a tax-free distribution and buy the boat? And the answer is yes, he absolutely can. Maybe not the wisest decision, but he absolutely can do it because he has $50,000 in receipts over the years for qualified medical expenses.
Good example.
Yeah.
Thank you. Well, I think that does it. So thanks again to Brian and Jim and to Lord Abbett. And of course, thank you all for joining us for this Epic Insight webinar. As a reminder, we will send out a copy of the slides and a recording of the session as a follow-up. So you're welcome to revisit anything and share anything you'd like. And of course, we welcome any dialogue related to HSAs and our My HSA offering. If you'd like to continue that, please reach out to your Epic RPS sales consultant or relationship manager. Thanks, everyone, and enjoy the rest of your evening and afternoon. Appreciate it.